Hello, everybody. Happy Thursday. I'm Coburn Shepik. Welcome to this week's Fireside Chat. Happy to be with you guys today. Hope you're having a fantastic week. We're going to just let a few people see if anybody else is piling in right here. So let's just give it just a couple minutes before we dive right into it. Okay, so we're going to dive right into it. So this week's topic, we're going to be talking about the distressed asset life cycle, and it'll be a bit on the educational side, but the reason for this call or the reason for this topic this week is because of the current economic times that we're in. Interest rates are rising, inflation is obviously through the roof, and there is going to be some distress that occurs. To what level? It's unknown. How much time? It's unknown. But we want to sort of recap on how this process looks so we can better be prepared for when it does. So we're going to dive right into it. And a few of the topics that we want to cover, obviously, the distressed life cycle. First, we want to just do a quick recap on what distress actually looks like. And then I want to give a quick introduction on what we're doing at Dovetail. And then we'll dive into this week's topic. So quick recap on what distressed assets actually are. Most people visualize distress as sort of what we see on TV, like rundown properties or home flips, mostly in the physical aspect of distress. That is distress, but distress is also much bigger than that and is more so on how the debt is performing. So we're talking about defaults here and non-performing loans and bankruptcies and foreclosure. This is real distress, stuff that you can't see, but usually when distress occurs physically, there's more distress going on than we actually know. So just to recap, distress is not just physical, that is distress, but what we're talking about today is actually what we don't see, which is defaults, etc. So I want to give a quick introduction to Dovetail Investment Group. We invest in exceptional real estate assets by combining our expertise with the track record of our best-in-class partners to insulate and grow the wealth of our investor consortium. So we're a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. We align with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. So our duties are to align with the best of the best operating partners in each particular sector. So what does this look like? A great operating partner would be someone who is established in a market and has an area of expertise, such as industrial or multifamily. So we align with those best-in-class operators who have a track record, who have been through multiple cycles, and who are very seasoned. And we align with those types of operators to place capital with. So a lot of the investors that we work with are established investors that are attracted to aligning with the best of the best opportunities. So the alternative to this is if you have an insight to someone, an operator in your market that's focused on a particular sector. If you were to want to diversify, you would need to find another operator, etc. So our duty is to align with operators in each particular sector across the commercial real estate spectrum to be able to diversify in other sub-asset classes. So a typical investment profile for us, like I mentioned, we're operating all across the commercial landscape because of how we align with seasoned operators. We're focused on both the acquisition and development side. I don't like to narrow us down to too narrow of an approach, because the reality is that times like this, there's a lot of special occasions and distress that comes up. And so we like to be prepared in for those opportunities to come. And so we diversify and we align with the best and the best operators in each of those sectors. And if you'd like to learn more about working with us, towards the end of this call, I'll share how we can get in touch with each other. So let's dive into this week's topic, which is the distressed asset life cycle. And like I mentioned before, this is a phase of real distress on paper. So defaults, foreclosures, all the bad stuff that we don't like. So it all begins with a performing note or a performing loan. And this is a performing loan is a buyer that has bought a building and they're up to date. There's no distress here, but this is the beginning process, right? It's a performing loan. Okay. The next step, there's no distress here. And so when we're buying stabilized assets, this is the area of where we're looking right now. Excuse me. So the next phase in this life cycle is subperforming. And subperforming loans are loans that have been delinquent for 30 days, usually between 30 and 90 days. Up after that point, then comes a notice of default, which we'll get into here in a minute. But up until this point, this is either the beginning of distress or this is just someone who's behind on payments. And so during this phase here, there is opportunity, but it's still very early. And so from an opportunity standpoint, this is where it's important to just to step back for a sec. If you're actually on the operating position and looking for distressed opportunities, this is where you need to be in bed with direct to sellers or brokers who are in with the best sellers. You need to have an in here to be able to understand what's going on. And during this time, it's still early. Obviously, the lender's trying to communicate to the borrower, hey, let's catch you up on payments. What can we do? And during this phase, there's also more likely the ability for the borrower and the lender to do a loan modification if some sort of situation is going on with the market, et cetera. This is sort of the early phase where the lender is willing to work with the borrowers. But if you're in direct to the seller or have an in with what's going on this distress side, then this is where you catch opportunity early and work with the sellers to position what you can do as a buyer. So the next phase is non-performing loans. This is where the actual notice of default comes in, where the lender is actually notifying the borrower that they're in default and that they're beginning the foreclosure process, et cetera. During this time, the risk to the lender is obviously increasing. So as time goes on, meaning that time goes on without payment or interest payment, the risk to the lender obviously increases. And so this is where note sales begin, where the lender is trying to potentially get out of this distress situation and sell the note for within their criteria to get out of the potential risk of the foreclosure process. So during this time are the largest discounts from a note perspective or from just a traditional acquisition perspective, as both the lender and the borrower are trying to figure out what to do here. And it's about to get ugly at this point. So I want to just tell a quick story. When I first got into this business years ago, I was originally focused on single family, and we were focused on distressed single family situations. And this is an area where non-performing properties or notice of defaults, this is where opportunity comes in, and you have to have a complete in here. We bought a handful of houses during this phase back in time before I moved over to commercial, and you wouldn't believe how much distress in this phase there actually is. Like during the financial crisis and during the major crises, obviously this defaults explode, but even on a regular basis, you pull a county record, speak with your title companies and get reports on your zip code. It's pages long throughout the year. So this is the biggest area for potential heavy discounts to buy. And it all depends on how much equity there is and what the debt markets are like. During this phase, there's also the potential to have assumable debt if you're on the buying side. And there's, at this time where we've had very low interest rates for years, there is going to be great opportunity to assume debt in this phase as well. So the next phase, the lenders actually filed for foreclosure, and this would be the last chance for the borrower to actually cure the default without going through the bankruptcy process. Again, during these two phases, this is where most note sales occur, which is, again, the lender selling the debt to a note buyer. So during this phase, it moves quickly. So you on the if you're on the operator side, or if you're on the investment side, this process happens very quick. And so we're talking about a few months here that we have to work with sellers and lenders, and to be creative to come up with solutions. So our duty as investors is to come up with solutions that are opportunities, and it takes creativity. So during this distress process, if you're actually investing in this life cycle, it takes real creativity because of the potential high interest rates or tightened credit that'll impact the economy enough for the real distress to occur. That's why it takes a lot of creativity during this phase. So if the borrower was to do a bankruptcy, this is where that would occur. This would delay the process of foreclosure. So big commercial developers, bankruptcies happen in this business, unfortunately, and they use this as a tactic to get out of debt. And the biggest investors in the world have experienced this, and unfortunately, it's just part of this business. But knowing where this fits in and what it causes delays to the lender, and it causes delays to the foreclosure process. So once a foreclosure happens, that opportunity pretty much closes, unless you're a foreclosure investor, of course. So if there was a bankruptcy, the next phase of this life cycle would be the foreclosure process. And so what does that look like? The lender has first filed, just to recap, the borrower's late on payments, 30 to 90 days. The next phase is a notice of default, where the time frame starts to shorten. The next phase would be the lender's actually filed for foreclosure, and then the borrower has the opportunity to proceed with a bankruptcy. And if they don't, now here we are at the foreclosure process. So the foreclosure process, as we know, is the lender has taken over, or is taking over the asset here to force a sale. And so the borrower does have the opportunity to buy back the note, which in most cases that does not happen. But this is where if the lender is willing to accept a bid, or if they do accept a bid, then there's a new buyer for the property and the deal's over. Or if they don't accept a bid because of whatever reason they did not meet their criteria, then the life cycle continues, which is an REO property or a real estate owned property by the lender. And so this is actually now the last phase of the life cycle, which is a cleansed asset, meaning that the foreclosure already happened, and now there's no liens on the property, and now the lender can go out and sell this real estate owned property to a new buyer. This could be, it's not distressed at this point. It is part of the distressed life cycle because it's an REO property, but there's no distress here. There's no solution to occur besides just have a new buyer. So if you are buying REO properties, or if you're there is opportunities to get discounts here, don't get me wrong, but as far as the opportunity within the whole cycle, this would be the highest price that you would potentially pay on average during that distressed life cycle. So just to recap here, the phase of this, there's only a short window. And if you have to be able to jump on these opportunities, you have to be either indirect with the sellers, really close to have lender and broker relationships, and have to be able to act quickly, or you're dealing with sellers directly. And that process obviously is going to come way prior than this distress even comes, because the window is so short. So back to my example of doing this in residential space, you have to act very quickly. Like, we've got 30 days to make this happen, or you're going to foreclosure. And so that's what happens during this life cycle is people become late, and it's a short window. You either need to act fast and catch up to speed, do a loan modification, or all of a sudden you're in default and you have a short window to act. And so us as investors, we need to have this network or this either with direct to sellers, with the best sponsors that have these opportunities, or with brokers, etc., to be able to pull up these types of opportunities. So during this life cycle, from an investment perspective, this happens during distressed times. This is a very opportunistic profile of investment, and the further it goes through the process, potentially the higher risk there is because of the potential for things falling through, or the buyer is going to go through foreclosure, etc. But during that late stage, before in the non-performing loan stage, that's where the best of the potentially the most rewarding types of deals occur. But you have to have an in for those opportunities. So as far as what these opportunities, when these opportunities are coming, we are at an interesting time. Obviously, this is we're experiencing extremely uncertain times. Just yesterday, inflation numbers came out, CPI numbers came out at 9.1, which is again breaking records for 40 years now or more, and we'll continue to see that, to see those records break. Real inflation, if we're looking at the tools that we used to use in the 80s, inflation's at more so like 16% right now. And so there is high inflation, and what comes with high inflation obviously is high interest rates, and that's where opportunities are going to start. That's where the real pressure gets put on the market right here. So the Fed is playing with some risky business right now with how aggressive we are. And because of this massive debt bubble, if interest rates move too fast, there is going to be some major opportunities to come, to say the least, because what happens is, for the operators that have invested over within the last 18 months, who have bought at the top of the market here, top dollar, the most compressed cap rates, and have been looking at an opportunistic type of profile where they're going to do X, Y, and Z in a value add scenario to jump up rents, etc. And where it's going to hurt is when this short-term floating debt needs to be refinanced. And so because of where interest rates were, not very long ago, operators have been projecting those refinance terms to be similar to what they've been over the last few years, which is not the case. And so when that refinancing comes into play, and new debt costs double than what they were projecting, there's not enough room there to refinance. And so there is a potential major wave of defaults coming that is going to get ugly. And the purpose of this call is to recognize those opportunities and to decide to get in with the right operators and sponsors to be able to take advantage of this. Asset prices have skyrocketed, rents have skyrocketed, also due to inflation, but more so because of the amount of liquidity that was pumped into the market. And now that might get all wiped out because of what's going to happen. So the opportunities that are coming, major distress potentially, a lot of special situations. And so what we're looking at, and so I want to give what we call our State of the Union here. We've got our pens down for the opportunities that are coming. We're preparing for massive distress. I believe this is going to be a once in a generation opportunity to capitalize on what's to come. And it's only because of what's going on in today's market, with inflation, with the amount of money that was printed over the pandemic, and now with the actual cherry on top, which is rising interest rates. There's going to be massive opportunities to come, and we want to be totally prepared and aligned with our partners to capitalize on these opportunities coming. So that's it for today, you guys. My name is Coburn Shepik. I'm so happy to be with you guys today. If you are interested in learning more about investing or investing alongside a partner like Dovetail and some of the operators that we're working with in certain sectors in the commercial real estate landscape, I want to invite you to join our wait list. Right now, we have our pens down as we're seeing what happens with interest rates. Later this month, I think the 27th, we'll kind of see what happens with this month's rate hike. We're expecting, another 75 basis point hike. It could be 1%. And so we've got our pens down right now because what happens over the next, 30, 60, 90 days is going to determine what's going to happen over the next 2 to 3 years and what we can expect. So if you're interested in learning more about what we're doing, I'd love to invite you to join our wait list. You can go to our website, dovetailig.com. That's dovetailig.com. Or you can shoot us an email at partners@dovetailig.com, and we can set up a call and get to know each other. So I want to thank you for everyone who's been on this call. If you're just getting on here late, we're going to do, this is recorded, and we're going to release our replays just in a few days. We actually release the prior weeks every Monday, so you'll look out for that post or email. This has been fun. Thank you so much for being here, everybody. My name is Coburn Shepik. Once again, if you'd like to join our wait list, go to dovetailig.com. That's dovetailig.com. Wishing everybody a fantastic rest of the week. And we'll see you next Thursday.